Welcome back to FX Limit. In today's video, we're diving into one of the most essential topics for any serious Forex trader: hedging strategies for managing risk. In Forex trading, risk management is everything, and hedging can be a key technique to protect yourself from unexpected market movements. So, let's get right into it. Now, when we talk about hedging in Forex, we're essentially talking about a strategy to reduce potential losses by taking opposing positions in the market. It's like having an insurance policy for your trades, where you're actively minimizing your exposure to high-risk situations. But like any tool, hedging has its nuances, and understanding the right strategies can make a significant difference to your trading outcomes. The first strategy we'll cover is the direct hedging strategy. This is probably the simplest and most straightforward way to hedge. Here's how it works. Let's say you're holding a long position on a currency pair like EUR/USD. If the market starts moving against you and you're seeing potential losses, you could open a short position on the same currency pair. By doing this, any losses from the long position are offset by the gains from the short position. Direct hedging is easy to implement and works well in volatile markets. However, one thing to keep in mind is that this strategy can lock up capital, as you're essentially tying up money in two opposing trades. You're waiting for a more stable moment in the market to close one of those positions. So, if you're using this strategy, it's essential to have a system in place to recognize when the market is settling. That's where tools like the Apex Trend Indicator come into play. By showing you real-time trend directions and providing reliable buy and sell signals, the Apex Trend Indicator helps you know when it's time to close one of your positions and lock in your profits. Our second strategy is multiple currency hedging. This strategy uses correlations between different currency pairs. For example, if you're holding a long position on EUR/USD, you could consider a short position on USD/CHF. Since these pairs often move inversely, any loss on one pair could be balanced by a gain on the other. This method is excellent for traders who are well versed in currency correlations and want to maintain a less direct hedging approach. One great aspect of multiple currency hedging is its flexibility. Unlike direct hedging, you're not holding two positions on the same pair. Instead, you're diversifying your risk across different assets. But this strategy requires a strong understanding of correlations, which can vary depending on global economic factors. Again, a tool like the Apex Trend Indicator can be invaluable here. By scanning multiple pairs and timeframes simultaneously, it provides trend signals across the board, helping you see which pairs are likely to move together or against each other. This allows you to set up hedges with greater confidence. The third hedging strategy we're going to discuss is the options hedging strategy. Options aren't as common in Forex as they are in stocks, but they're still available through some brokers and can be a powerful tool for hedging. Here's how it works. Let's say you have a long position on GBP/USD, and you're worried about a possible market downturn. You could purchase a put option for GBP/USD. If the market falls, the profit from the option helps cover any losses on your long position. Options hedging offers more flexibility than direct hedging since you don't need to tie up capital in a second position. However, keep in mind that options contracts require an upfront premium, so there's an additional cost to this form of hedging. It's not a strategy for every trader, especially if you're trading with a limited budget, but for those who are familiar with options, it can be a great way to mitigate risk without sacrificing as much liquidity. And, as always, having the Apex Trend Indicator can be a game changer here. The indicator's accuracy in spotting trend reversals can help you decide the best time to buy or exercise options for maximum efficiency in your hedging. Next up, we have the counter-currency hedging strategy. This approach involves taking positions in pairs that share a common currency. For instance, if you're long on USD/JPY, you might take a short position on AUD/USD. The idea here is that if the US dollar strengthens, one trade could benefit more than the other loses. This strategy can work well for traders who are focused on specific currency trends, such as a strengthening or weakening dollar. Counter-currency hedging requires keeping a close eye on the strength of individual currencies. It's a strategy that demands precision and real-time insights, which is where the Apex Trend Indicator once again shines. With its multi-timeframe, multi-pair scanning capabilities, the indicator quickly highlights potential opportunities across various currency pairs, helping you identify those perfect counter-currency setups in real time. Our last strategy is the partial hedging strategy. Sometimes, instead of fully hedging a position, you might want to hedge a portion of it. For example, if you're holding a large position on EUR/USD, you could open a smaller short position on EUR/USD as a partial hedge. This way, you're reducing your risk exposure without fully giving up the potential profit from your original position. Partial hedging is popular among traders who have a high degree of confidence in their primary trade but still want a buffer against sudden market changes. This strategy is more nuanced because it requires balance. Hedging too much can limit your profits, while hedging too little may not provide enough protection. But with a reliable tool like the Apex Trend Indicator, you can better time your entries and exits, allowing you to adjust your partial hedge based on accurate trend signals. By relying on Apex's non-repainting buy and sell signals, you can make more informed decisions about when to increase or decrease your hedge. So, there you have it, 5 effective hedging strategies to help you manage risk in Forex trading: direct hedging, multiple currency hedging, options hedging, counter-currency hedging, and partial hedging. Each strategy has its unique strengths and considerations, and the best one for you will depend on your trading style, experience, and market conditions. Remember, hedging isn't about eliminating risk entirely. It's about managing it wisely to protect your capital and preserve your gains. And, as always, having the right tools at your disposal can make all the difference. The Apex Trend Indicator, for example, provides you with clear trend signals, trend reversal alerts, and success rates across multiple pairs and timeframes, making it an essential asset for any hedging strategy. Whether you're a beginner or an experienced trader, the Apex Trend Indicator can give you that extra edge in managing risk effectively. Thank you for watching FX Limit. If you found this video helpful, make sure to like, subscribe, and hit the notification bell to stay updated on our latest Forex insights. Happy trading, and we'll see you in the next video.